Alright, what is going on YouTube fam? Welcome back to the channel. It's Daniel FX here. Today I'm going to be talking about supply and demand, support and resistance, your mum and your dad, just key levels in general, you get me. So we're going to jump right into the charts, but first and foremost, allow my dusty trim. I know a bunch of you guys are about to comment this and just, yeah, allow it. I'm going to Morocco in a couple of days and we're getting the trim literally later on today. I just happened to record a bunch of videos while I had a dusty trim, so please allow me. But yeah, let's hop right into the charts and let me show you guys my personal system, my methodology behind how I draw my key levels, because it's actually a very common question that I get all the time. So run the intro, gang. So that was a bit of a nuts intro, mate. I don't know who done that one, but let's jump into the charts. So first and foremost, let me show you guys the traditional support and resistance or supply and demand. One thing I want to make clear from the start of the video is this is not necessarily the most technical way to do it. Like, I'm not some institutional trader who's been trading for the banks. Like, it's just my personal methodology, how I like to draw my key levels and where it works best for me and the pairs and indices that I trade in it. But yeah, cool. So your traditional support and resistance or supply and demand pretty much is all kind of the same concept, but it's just areas in the market where price tends to react to or bounce off of or reject or respect, whatever you want to call it. But it's all the same concept, same principle. Now, this is your traditional supply and demand. You have 3 taps to the upside, 3 taps to the downside. Now, I'm sure we all initially started off on baby pips, and we were taught initially that after price is tapped into a key level 3 times, it is then safe to assume that on the 4th tap, once price comes back down, you can use that level as a level to buy or sell off of. Pretty like standard, like very basic trading shit, innit? Now, again, this does work. I'm not saying this doesn't work, because obviously it's just like a foundational aspect of trading. But this is not really how I like to draw my levels. I don't usually wait for 3 taps so I can come and buy on the 4th tap, because it's retail, like slow kind of. I don't know. I don't know how to explain it, but it's just, why would I do that? It just doesn't make sense for me. In my system and my strategy, there's 2 key levels that I like to draw. Now, I know my chart looks a little bit messy right here, but I'm actually going to draw it out for you guys, and then we'll go through a live example. But there's 2 key levels that I like to draw. Because I'm predominantly a price action trader and I like to trade with the trend, oftentimes, especially on the indices that I'm trading on the lower time frame, when we form this kind of structure, we don't tend to leave 3 taps. Like, we don't, US30 is not going to come back down, fuck about a couple times, leave 3 taps, and then pull back up and then come down for a 4th tap so I can get my entry. That's not how it works. If I waited for that 3 tap, I would never find the key level and I would miss every trade. And that's simply because I understand the characteristics of the instrument I'm trading. However, on maybe a pair like, for example, NZD CAD or maybe GBP AUD, that do have a tendency to pull back and to consolidate and to hold around a level, maybe this sort of system would work. But again, it all differentiates dependent on what instrument you're trading and understanding how that market likes to move in it. So again, coming back to US30 or NASDAQ or German 30, because there's such high volatile pairs and we don't tend to pull back too tough like that, you only really get one opportunity to enter on the pullback. If you don't enter on the initial pullback, you missed it. So what I tend to do is I like to draw from relative structure. So either from structural highs or from structural lows, dependent on what direction I'm trading in. But I personally only trade with the trend. I like to draw from structural points in the market. So for example, here we've made a higher high and a higher low, and then we've broken structure to the upside and created a new higher high. I would then draw 2 key levels, and dependent on what kind of market we're in, I would use either levels. I would either draw from the structural high and anticipate a small retracement or a small pullback to that structural high before a continuation higher, or I would draw my key level from the structural low, again anticipating that retracement and that pullback and that respecting. Now again, notice how I say, don't know what just happened there, but notice how I say anticipating a certain move. Like, I'm not just going to assume the move's going to play out. I'm not just going to assume that these levels are going to get held, but I actually like to wait and watch price, respect the level and hold it. And usually I do this on a lower time frame. So if you guys have been on the Learn and Earn or any of the live sessions, you've probably seen this live in person where we'll draw a key level, we'll wait for price to come and tap that key level, and then actually wait for it to hold, show us some sort of change in character, depletion, etc., before we look at taking a move. Now, again, that's a completely different strategy for a different video, but this is the foundation of this. All right, so right here, we're clearly in a nice uptrend. Price is making higher highs and higher lows. Now, notice how I'm on the 5-minute time frame on US30, but this applies to all of the time frames on every instrument. But dependent on what you're looking at and what time frame you're looking at, it will react differently, or the same principles will apply in a slightly different manner. So bear that in mind when you go ahead and backtest this. It may look different for you, granted, if you're trading a different time frame or a different instrument. But on US30, on the 5-minute, this is how this looks. So cool. We're in an uptrend, pricing making higher highs and higher lows. We're in a pretty nice trending market. Now, notice how this doesn't look as clean as that example I just showed you. Well, that's because the market is never that perfect. We're never that clean. Like, it just is what it is. You get messy price. You have to kind of find the setup within the noise that's going on. So you see right here, we have a structural high, and then we've come down and created a structural low. So in other words, we've made a higher high and a higher low. And then we've broken this structure to the upside and created a new higher high. So at this point, I would then be anticipating the retracement back down to create a lower high somewhere so I can get in on the continuation. Now, like we just discussed, I have 2 key levels. Now, in this kind of market, it doesn't really look like we've got a crazy amount of volume. Granted, this is like what, 240, so it's just after the New York Stock Exchange open. So I would most likely be anticipating a deeper retracement in this sort of scenario. But just for argument's sake, I would have my key level here anyway, just to see if this one did get respected and held. But more than likely, I'm actually more interested in this little lower level right here. So cool. At this point, you'd sit here, you wait and watch price action. Notice how we immediately melted through that level. Again, it looks like we kind of broken it, violated it. Even right here, this looks like more of a fake out move than an actual like respecting the level. So I'd be waiting for that second level to get tagged. Now, usually I like to set either alerts at my level, or I'll sit there on a live session with like the learn and earn, and we'll sit and actually wait for the price to play out. But if you're just trading by yourself and you've got stuff to do, obviously just set an alert and wait for price to tag your level. But yeah, at this point, I would then be waiting to see price respect the level, show me signs of depletion, show me a change of character. Now, again, I'm going to make a complete full breakdown on what I actually mean by change of character and that word depletion, because I use it all the time. But just very, very briefly, you can just see here how the candlesticks are telling you that we're depleting, we're exhausting this bearish price, we're exhausting the sellers. Sellers have exited, the buyers have stepped in, we're starting to wick, we're starting to respect the level. And I'd want to see another confirmation candle. So right here would probably be a nice entry candle. Granted, I've seen how price plays out, so I'm not going to sit here and just forecast random bullshit when I've seen price. But it to me, it's a nice blatant like double bottom. Price has wicked numerous times. We've had that little almost a shift in momentum. Again, I'm going to make a full breakdown, so don't watch. But at this point, you'd be looking for that continuation higher. And we get that continuation higher. And furthermore, if you missed your initial entry up here, even just having a key level there means you can potentially either catch a scaling entry or catch a later like different position if you missed the first one. So boom, right there. That's how I draw my key levels. Super, super simple. It's nothing groundbreaking, but you're just looking at structural highs or structural lows. And again, this works in both ways, in an uptrend and in a downtrend. It's the exact same principle. But the important part is you're waiting to see price respect the level. It's not even necessarily about how you draw your key levels, but it's how you wait for your levels to be respected. Because any level can be broken. It doesn't matter how well you draw your levels. Any level can be broken. But you are waiting to see price respect your level and give you a confirmation in your direction. But yeah, that's all, gang. I'm going to see you in the next one. Peace.